Are there any tax deductions for buying a house? Hi everyone, my name is Nicole Green. I'm one of the tax advisors at Robert Hall & Associates, and today we're going to talk about if there are any tax deductions when you purchase a house. Spoiler alert, there absolutely are. The government loves it when you purchase a house. Please make sure you like and subscribe so you don't miss out on any of our upcoming videos. So, what are the tax deductions for buying a house? We're going to talk about interest, we're going to talk about property tax, we're going to talk about the SALT tax limit as well and ways that you can get around that. So, what are the tax deductions when you purchase a house? Purchasing a house is such a big deal. I don't care where you live. I live in California, so it's a really big deal here in California because it's really, really, really expensive. But anywhere you live, even if it's much, much cheaper, like in, I don't care, Mississippi, Iowa, or something like that, it's still a huge deal. It's still probably your largest asset. And the government loves the fact that you are investing in America. You're investing in the country by purchasing a house. They want people to be landowners. They want people to have their own home. And you can see evidence of this in different ways. There's sometimes different credits for first-time home buyers, and there's different things that you can have. But one of the most consistent ways that you can see that the government really leans into people that purchase homes is with itemized deductions. When you purchase a house, you are now more likely than not going to be able to itemize. When you have the standard deduction, it doesn't matter what your deductions are. If you take the standard deduction, you're going to just have whatever that amount is. You're not going to count your medical expenses or, your charitable donations or any of that. It's just basically saying like, hey, let's average everything together and then this is the standard deduction. However, your personal expenses might be larger than the standard deduction, and that's when you itemize. You should always figure out what your itemized deductions will be. And this is where buying a home comes into play. We've got two main things. We have your property taxes, which we're going to actually get into a little bit more later. And then we have our mortgage interest. Your mortgage interest is deductible. Your property taxes can also be deductible as well. So when you purchase a house, if you're paying for the house through a mortgage, you're able to deduct the interest that you pay. And keep in mind, if you're doing like a 30-year mortgage and you're, just paying the minimum payments at like 8%, you're going to be paying more than the actual house cost. Like if you think about it, like let's say your house was $250,000 and you did a 30-year mortgage at 8%, you're going to pay like $256,000, if my math is correct, in interest over that 30 years. So you literally pay more than your actual house in interest because you're going to pay like $500 some odd thousand, which don't recommend. I recommend you pay more than the minimum payment, but at least you have that as a deduction. If you can't afford that, if you can only afford to do the minimum payment, at least you have that deduction. So over the 30 years, you're going to be able to deduct the $257,000. You don't get to deduct the principal because it's your primary residence. And so your mortgage interest also does have a cap. And so if you get a mortgage that is over $750,000, you're only allowed to take $750,000 of interest of $750,000 of your mortgage of interest. So let me explain it a little bit cleaner. Imagine I get a mortgage for $1 million. My mortgage interest, not the principal, but the mortgage interest that I paid over the years, $10,000. I am able to deduct $7,500 of my mortgage interest. The other $2,500 it's not lost if you have a good accountant, but it could be. If you have a mortgage that is $750,000 and the mortgage interest is $10,000 or $700, whatever, and the mortgage interest is $10,000, you can take that full $10,000. The only time you're limited about the amount of interest that you can take is dependent on the mortgage balance. And if you just purchased the home and it's, $1 million mortgage and you're paying it off, and 2 years later, you're down to $750,000, the 2 years at that point, you can take the full interest. Every year we calculate what your mortgage balance is. And so that 750 limit is really, really important that you adhere to that, because that a Schedule A audit is so common, and it's so easy for the IRS to understand that you've overtaken or you've taken too much of your mortgage interest, because they get the 1098. So you're going to get a 1098 from your mortgage company. There's a couple of really important things that you need to remember about this 1098. One, it is very common for your mortgage company to change, especially when you first purchase the house. When you first purchase the house, it is very, very, very unlikely that that mortgage company is going to be your same mortgage company for the entire time that you have that mortgage. They usually will immediately sell that mortgage to another mortgage company. And so at that point, you will have multiple 1098s, and you need to make sure you get all the 1098s, one from the old mortgage company and one from the new mortgage company. And sometimes you don't even know that you'll get like a letter saying like, hey, they sold it, but it doesn't affect your payments because they still do the automatic transfer or the automatic debit without even like letting you know. They just send you a letter saying like, hey, this is now your new mortgage company. And so it's really, really important that you make sure you're getting that. Or if you refinance, you'll have multiple 1098s as well. And so you need to make sure that you're getting all the 1098s, and so that it can collectively be calculated. Let's imagine you have one 1098 and your mortgage is $700,000. You refied and your mortgage is now $725,000. You will combine both of those mortgage interests because your mortgage never got over 750. And so you'll combine both of those mortgage interests for the deduction. And people right now that have purchased homes and, recently you've paid quite a bit in mortgage interest because, interest rates are a little high, a little lot high. And so, it's a lot, but at least it's a deduction. If you're able to do that and you were able to do that, at least you're able to get that deduction, which is a really good thing. Okay, so that's the important thing about 1098s. Make sure we're getting all the 1098s. If they sell your mortgage, that's not a big deal. It's very, very common. You can even have 3 1098s in 1 year. That happens. Like you purchase the home, it'll for sure get sold right after you purchase the home, and then maybe it gets sold again. A lot of selling of mortgages will happen when interest rates are really high or interest rates are moving like very rapidly. So that's a totally normal thing, but just make sure you get all the 1098s. The next thing that we're going to talk about is property tax. So property tax is a really, really big thing. So when you're having your itemized deductions, there's 3 main deductions we have that are itemized. There's 4 deductions in total, but there's 3 main ones. We've got the SALT taxes, that's state and local taxes. I know we call it SALT and the T stands for taxes, so it's a little redundant, but we still call it SALT taxes. We've got mortgage interest, and then we have donations, charitable donations. If you give money to a GoFundMe, if you give money to a GoFundMe or the Red Cross or the church or something, or you donate items to the Goodwill, that's when you will have those charitable deductions. And then the other deduction that you have is medical expenses. We're not really going to get too much into medical expenses, but medical expenses really is not going to be a big deduction for people because it's the first 7.5% of your AGI is non-deductible. And so if my AGI, my adjusted gross income, is $100,000, the first $7,500 of medical expenses is non-deductible. If I have $7,502 of medical expenses, I can deduct that $2. Depending on what your AGI is, like $7,000 of medical expenses is something seriously happened, which God forbid, or Buddha forbid, or whoever forbid. I hope that medical expenses are not a common deduction. You can see usually people have surgery when sometimes when mothers have babies, you're not going to be able to do the deductions for in vitro. It's only mandatory health expenses. So like elective stuff you can't do, like in vitro surrogacy, breast augmentation, nose jobs, or unless it's required by your doctor, that's the only time you can take it in. Anywho, the other main expense that we have is property tax. So if you live in a state like mine, California, there's a lot we pay in property tax, especially if you recently purchase a house, and there's different ways you can lower your property tax and, different things, especially if you're inheriting a property, and to help with that. But our property tax is outrageous. And so there is what is called the SALT tax limit, and that is $10,000. So that is state and local taxes. State and local taxes include property tax, because I pay that to California. Local taxes also, if you pay like a city tax, or if you pay like a village tax, or something, like maybe if you paid for like an easement or something like that, if you pay a tax. Sales tax, which again, nobody's going to add up all of their sales tax that they spent at like Bergdorf's, or sorry, let me say something more relatable, that they spent at like Macy's. Like nobody's going to add up all of those, or like at Target. But like if you purchase a car, you paid a ton in sales tax if you purchased a car. And you're paying that to the state. So that will be included in state and local taxes. If you also paid your state taxes during the year through withholdings, that is going to also be part of your state and local taxes. And so property, I think I already said, but property tax is obviously one of those as well. And so this $10,000 limit is painful. High income earners will hit the $10,000 limit very easily, because they obviously should be paying their state income taxes throughout the year, so they're not getting hit with crazy penalties. And then also people that live in a high property tax state is going to be paying a lot in property tax, which is there as well. And so it's very easy to hit the $10,000 if you're itemizing. Most people do, and that sucks. But if you own your own business, there's a way. I mean, you really are getting around it. You're getting around the $10,000 cap. It's called PTE. The way you can get around it is PTE, pass-through entity tax. Now, what this is if you have a business, it cannot be a single member LLC. It cannot be a sole proprietorship. It needs to be a partnership, a corporation, S Corp, C Corp, whatever. Because a single member LLC is a disregarded entity, which means you're telling the government, hey, I don't want to have any effect with it in terms of taxes. And so single members don't count. But if you have a partnership or an S Corp or a C Corp, what you can do, and it varies depending on the state, but you're able to pay some of your state taxes through the business. So you'll get that deduction from your business income. Let's imagine I paid $10,000 in state income tax, and then let's imagine I paid $20,000 in property tax. So I'm $30,000 of state and local taxes. My SALT taxes are $30K. And I only get a $10,000 deduction, but I have my own business. And so I'm going to elect to do the PTE. The amount that it takes for PTE will vary state by state. But here in California, it's going to be 9.3% of the taxable income. So if my business is going to be, let's say, $100,000 of taxable income, I'm going to have my business pay $9,300, which is going to give me a credit. And so because my business is paying the tax, it's a deduction on my business side. And so then when I itemize, I have a $9,300 credit, but I'm now able to take half. I'll have $20,000 of SALT taxes because I have just my property tax. So I still miss out on $10,000 of property tax, but I got in now $19,300 of SALT taxes, because I'm able to have that as a deduction on my business, the 9.3, and I'm able to have the $10,000 on my personal. And so there is a way for you to get around it. How much is your PTE? That depends on the state that you're in. Like, I believe Arizona is like 2.5. It depends what state you're in, because that's helping with that SALT tax limit. So we talked about the deductions for when you purchase a house, mortgage interest, making sure that we're counting all of our mortgage interest, making sure we're getting all of the 1099 so that we're able to get the full 750 worth of mortgage interest, 750,000 of mortgage interest. We talked about property tax and SALT taxes, and then we talked about a way to help with that $10,000 SALT tax limit through PTE if your state conforms to that and has a PTE. Keep in mind, I don't believe all 50 states have PTE. It depends. So those are the three main things that you can have as deductions when you purchase. Those are the two main things that you can have as a deduction when you purchase a house. Keep in mind, you're not going to depreciate your house because this is your primary residence. And so as a primary residence, when you sell your house, you're going to get an exclusion. And so it's not going to be a business property, so there is no depreciation. It's a personally held piece of property. And so you'll get an exclusion of either $250,000 or you'll get an exclusion of $500,000. Meaning, if I sell my house, I bought my house for $100,000 and I sold my house for now $1 million, I have $900,000 of capital gain. I'm married, and so I will only pay $400,000 of capital gain because we have that $500,000 exclusion as it's our primary residence. To get that exclusion, you need to live in the house for 2 of the last 5 years. It doesn't need to be the most recent 2 years, and it doesn't need to be 2 consecutive years. It just needs to be in the last 5 years. Did you live in that house 2 years? It could be, if you're, it could be anything. And so sometimes people do move around to help to be able to get, if you're selling a rental or something like that, and then you move into your rental for 2 years so that you can have that exclusion. That's totally fine. You can take the exclusion 2 times in 5 years because you could live in 2 different houses in 5 years because it's only 4 years that you need, 2 for each of the properties. And so that's totally fine. And so moving around definitely helps. Primary resident is a wonderful, wonderful asset. Just make sure you don't overpay for your primary residence and make sure you can afford, to put away a good little nest egg. Because stuff always happens. All right, thank you so much. Make sure you hit the like and subscribe button. If you have more questions, please feel free to reach out to us and we can set you up with a free 30-minute consult. Go to our website, roberthalltaxes.com. Put your information, we'll contact you. The link is also going to be in the description and you'll be able to sit with me or one of my lovely colleagues and ask your questions. All right, have a great day. Bye-bye.